This conference will now be recorded.
Hey, what's going on, guys? Carlos, CEO of G.A.R Capital. Now we're moving on to more of the wealth building aspect of it. We talked about cash, we talked about credit, we talked about credit scores, we talked about debt, we talked about how to get out of debt, your savings, and now we're moving on to the wealth building. Not everything is the stock market, just so you know. Again, there's other ways to make money and build your wealth. There's a word, most words, there's a word, a couple of words that everyone talks about: passive income. Passive income. What is passive income? Money you don't have to work for, it just builds. So let's look at our friends at Financial Samurai, their website, love them. They're ranking the best passive income investments. I'll read them out to you, talk about them, break them down, and see my opinion on it. And see maybe some of these are working out for you. And some of these I actually do. So again, everything we talk about here, guys, feel free to research yourself. Don't ever invest in something you do not understand, as always. Don't ever put a dime in something you don't understand. Research yourself. It's your money. You're responsible for it. Make sure to research. Don't let these videos be the only thing you watch. Read other things. There's great books out there, great resources. The internet is at your fingertips. Feel free to put the work in and do the research, guys. So with that being said, let's rock and roll. Financial Samurai, ranking the best passive income investments. Take a look at their website. They're amazing. I love them to death. Passive income, as we talked about, starts with saving. Yes, it's all about saving. We talked about that first. That was the first thing we were doing: getting out of debt and investing and saving. Have an emergency fund and open up some money in your budget. Then you can start investing. That's the key. So ranking various passive income investments. Forget 401k, whole different story. You have your 401k, you're already doing that. You have your stocks, you're already doing that. Let's look at some other ways to make some money. So a risk score of 10 means no risk. Return score of 1 means the returns are horrible compared to the risk rate. A feasibility score of 10 means everyone could do it. Liquidity score, we talked about liquidity, of 1 means it's difficult to withdraw your money without a massive penalty. Activity score of 10 means you can kick back and just relax and do nothing to earn the income. It's all based on risk, return, feasibility, liquidity, and activity. That's how they're ranked. So there's 8 main passive incomes investments to consider. So just a heads up. So to make ranking as realistic as possible, according to Financial Samurai, every score is relative to each other. Furthermore, the return criteria is based off to generate $10,000 a year in passive income. Let's get started. Number 1 is a CD or money market. Money market's like online savings we talked about. The difference between a money market and an online savings is that you can write checks from your money market. Stay away from that. You just want to get something with the best return. So CD, as you know, CDs are crap. We talked about it. They don't pay a lot of yields. Back in the days, it was 4%. Talking about 20 years ago, not anymore. Now you're barely getting 2.5%. So the great thing about CDs is that there's no income or net minimums to invest, unlike many alternative investments, and they're pretty much the safest thing on the board because it's protected by the FDIC, Federal Deposit Insurance Company, up to $250,000 per individual and $500,000 per joint account. So you don't have to worry about losing any money. You will not lose money if you're in a CD. So just several years ago, money market CD rates were only 0.1%. You can get an online money market paying 1.8. We talked about that. I'd rather you be in an online savings so you have access than a CD, but we're here talking about CDs. Anyways, the risk, there is no risk. It's a 10 return. 3, rates have increased. Not really. Feasibility, pretty easy. Liquidity, and there's some penalties, a 6. And activity is 10. You don't do anything. Just grows. 39 of a total score. Next one, fixed income and bonds. What is fixed income? What's bonds? You're just lending money to a corporation or a government so they can use it, and they pay you. It's kind of like your loan officer. That's it. But you're not going to get those rates like credit cards do. Just keep that in mind. As interest rates have been going down the past 30 years, bond prices have continued to go up. Remember, bond yields and bond prices move differently. They move inverse from each other. That's investment talk. Just a heads up. With a 10-year risk-free rate at roughly 1.6%, first half of 2020, it's hard to see interest rates declining any further. With that said, long-term interest rates can stay low for a long time. Look at Japanese interest rates were negative. Inflation is higher than the nominal interest rate. Bonds provided a terrific defensive allocation to an investment portfolio. Yes, of course, especially during times of uncertainty like we're seeing US-China trade wars. Yep. If you hold a government bond until maturity, you will get all your coupon payments, their payments to your interest and principal back. But just like stocks, there are plenty of other bond investments you can choose to. So you could buy a bond ETF like IEF, which is the 7 to 10-year treasury, MUB, which is municipal bond fund, or MUN, or fixed income fund like PTTRX, which is the PIMCO Total Return Fund. All they do in PIMCO is bonds. You can also buy individual corporate municipal bonds. If you want to lend Apple some money, they'll sell you a bond. Municipal bonds are especially enticing for higher income earners who face a higher tax rate. And what's great about municipal bonds, they grow tax-free. You can also buy treasury bonds directly from your online brokerage firm. If you want to buy a 10-year bond for the government, they will sell you a 10-year bond if you want. The main concern is the future of interest rates, guys. If interest rates do go higher, the bonds that you own will decline in value because it'll be worth less than what you paid for. That said, as long as you hold the bond into maturity, you'll get your initial principal back and the coupon payments if you're buying a highly rated bond, AA or above. It goes to AAA, which is government bonds, Microsoft, Johnson & Johnson, and then there's junk bonds. You want to stay away from that. Junk bonds are like triple Bs and double Bs. You probably heard that from the movie The Big Short. Bonds are a great investment to increase volatility in portfolio. I hope everyone at least takes advantage of lower interest rates and refinances their mortgage. That's another way to do things. Here are the interest rates for mortgages, how they've fallen. So let's talk about the risk of interest rates. Yes, bonds can default. Very rare. Depends on what you buy. Government bonds are not going to default. Keep that in mind. So risk is 8, return is 5, feasibility is 10, liquidity is 8. You can sell anytime you want. And activity is 9. You don't have to do much. Total score of 40. Next one, real estate. Everyone knows real estate, right? Real estate is my favorite, his favorite asset class to build wealth. Mine's stocks. I like investing. What can I say? But it's easy to understand, provides shelter, and generates income. The only thing about owning physical real estate is that it ranks poorly in the passive variable due to tenants and maintenance. Owning your own property means that you are neutral in the real estate market. Renting means you're short the real estate market, and after buying 2 or more properties, you're actually long in real estate. This is why everybody should own their primary residence as soon as they know they want to stay put 5-10 years. If you're going to stay where you are for 5 to 10 years, just buy your own home and you're better off. Inflation, too, is a powerful force to combat. In order to generate $10,000 net operating profit after tax, NOPAT, through a rental property, you must own a $50,000 property with an unheard of 20% net rental yield. Very rare. If you own a $100,000 property with a rare 10% net yield, you'll get $10,000 a year. More realistically, in order to make $10,000 in passive money through real estate, you need to own a $200,000 property that gives you a 5% net rental yield, which is more likely. In expensive cities like San Francisco and New York City, net rental yields, cap rates can fall as low as 2.5%. You only make 2.5% on your money. For that, just buy a CD. This is a sign there's a lot of liquidity buying property mainly for appreciation, not so much for income generation. But what's good is that if you buy real estate, the price of the property can go up. This is a riskier proposition than buying property based on rental income. So you have real estate based on generation of income, cash flow properties, and kind of like flipping properties, meaning that you're just waiting for the asset to go in value. In inexpensive cities such as the Midwest or South, net rental yields can easily range from 7 to 12%, although appreciation may be a little slower, meaning you'll get more cash flow, more renters, but you're not going to get a value like you would in a hot market like Vegas, a Phoenix, San Francisco, New York, Miami, etc. So this gentleman on Financial Samurai says he's bullish on the heartland of American real estate. He's been especially buying commercial real estate through real estate crowdfunding, more on that in a minute, and specialty REITs, real estate investment trusts. We'll discuss more below. He said there's a golden opportunity to buy physical real estate in 2020 and beyond because prices have lagged the S&P. S&P gained 31% in 2019, and mortgage rates have come down and affordability has gone up. So the risk level is at 5, return is at 8, feasibility is at 7, liquidity, not very liquid, 3, activity, there's some activity you gotta do, total score of 29. The next one is peer-to-peer lending. Peer-to-peer lending started in San Francisco with Lending Club and Prosper in mid-2000. This is basically lending people money. The idea is peer-to-peer lending is to disintermediate banks and help denied borrowers, subprime, get loans at potentially lower rates compared to larger financial institutions. If you do a loan with Lending Club, you are borrowing money from people in general, peer-to-peer. You're not borrowing from a bank. Lending Club is not a bank. What was very nascent in the industry has now grown into into a multi-billion-dollar business with full regulation. With a diversified portfolio of 100 more notes, the P2P lenders claim investors can make an annual return of 5 to 7%. The return used to be higher, but the increased money supply has brought returns down. The biggest problem, according to Financial Samurai, is that P2P lending, people is not paying you back. There's the risk. Sometimes they don't pay you back. There's sometimes that they just sit right with people breaking their own obligations. So again, you can borrow, you can invest on different pieces of paper, whether it's subprime or prime lenders. Prime lenders pay lower rates, subprime pays a little more, but again, you have more risk. Big short stuff, right? Risk is at 5, returns at 6, feasibility at 9, liquidity is at 6, activities at 8, total score of 34, a little better than real estate. Dividend investing, my favorite. Investing in large cap dividend companies is one of the best ways to build passive income. The dividend aristocrats are a list of blue chip companies in the S&P that have demonstrated a consistent increase in dividend payouts over the years. Let's say a company earns $1 a share and pays out 75 cents in a form of dividend. That's a 75% dividend ratio. Let's say the next year the company earns $2 and they pay out $1 in form of dividends. Although the dividend payout ratio declines to 50% due to the company wanting to invest more in their company, CapEx, capital expenditures on expansion, at least the absolute dividend amount increases. Dividend stocks tend to be more mature companies that are past their high growth phase, meaning they're not going to reinvest in their own company, just very cash heavy. As a result, they're very less volatile. Utilities, telecoms, AT&T, Verizon, for example, financial sectors, tons of cash, JP Morgan, Citi, Wells Fargo, Bank of America, tend to make up the majority of dividend paying companies. And you can see the S&P yield versus the 10-year. It tends to go close to the 10-year interest rate because they have to keep up. If not, they're going to go with bonds. So they have to be competitive. Tech, internet, biotech, on the other hand, tend not to pay dividends because they're reinvesting most of their retained earnings back into their company for further growth. Amazon doesn't offer a dividend. Google doesn't offer a dividend. Facebook doesn't offer a dividend. Microsoft does. They're a more mature company. Apple does. They're a more mature company. Their growth stocks can easily lose investors tremendous value over a short period of time. Keep in mind, it's all about growth. To achieve $10,000 in annual passive income at the S&P's 500's 1.8 dividend rate, you would need to invest $555,000, or you can invest $154,000 into AT&T's 6.5% dividend yield. That is not updated. That's right around 5.5. Depends on your risk tolerance. If you want to put $154,000 in AT&T, you'll get $10,000 a month, $10,000 a year in passive income. If you put it in the S&P's dividend fund, you need to put $555,000 in order to make $10,000. One of the easiest ways to get exposure to dividend stocks is ETFs like DVY, VYM, SPY-D, for example, or index funds. In the long run, it's very hard to outperform any index. Therefore, the key is to pay the lowest fees possible while being mostly invested in an index fund. It's fine to take 10 to 20% of your investable assets to pick out our performance. So risk is 6, return is 7, feasibility is 10, anyone can do it, liquidity is 8, selling time, and activity, you're chilling, only 10, total score is 41. Next one, this is a little more in depth now. Private equity investing. Private equity investing can be a tremendous source of passive income with the right investments. If you find the next Uber, the returns will blow out every single passive investment out of the water. But for every Uber, you have a WeWork, so keep that in mind. WeWork didn't do so well. But of course, finding the next Uber is a tough task, since most private companies fail and the investment opportunities always go to the most connected investors, like the VCs. VCs are the venture capitalists. The most liquid of the private investment are investing in equity or credit hedge funds, real estate funds, or private company funds. They usually have a 3 to 10 year lockup period, meaning that you can't touch that money. The least liquid of private instruments will invest directly into a private company. So you can find hedge funds through your broker, and I would say, hey, I want to be an angel investor. I want to get the new Uber, the new Lyft, the new WeWork, whatever, Airbnb, and they'll get you on the ground floor, but you'll be locked in their money. Access to private investments are restricted to accredited investors. Accredited investors, you need to make a set amount of money every year, which is why feasibility score is only 4. Not everyone's there. But activity is a 10 because you can't do anything even if you wanted to. You're investing for the long term. Love it. The risk and return score grade depends on your investing acumen and access. Gaining $10,000 a year in private equity investing is kind of difficult to quantify unless you're investing in real estate or fixed income. Such funds generate about 8 to 15% returns, which equates to $83,000 to $125,000 in capital. Risk is a 4, return is a 7, feasibility a 4, liquidity is a 2, which you can't access, activity is a 10, because you're not doing anything, total score is 27, which is the lowest of the board. Next, real estate crowdsourcing. I do this. Currently, my favorite passive income source is real estate crowdfunding, which allows individuals to buy a piece of commercial real estate project that was once only available to ultra high net worth individuals or institutional investors. Owning of individual physical real estate is great, but going all in on one asset in a particular location with leverage, you want to be careful. You don't want to go all in on something. If the market goes down, your concentrated investment could lose big over time and you're forced to sell, like in the financial crisis. Real estate crowdsourcing allows you to surgically invest as little as $500 into residential or commercial real estate project for potentially 7 to 13% annual returns based off historical data. Such returns are much better than average private equity, CD, bond market, P2P, and dividend investing. Unlike P2P, with real estate crowdfunding, you at least have a physical asset as collateral. So how it works is submission, basic screening, due diligence, and purchase by Fundrise. I invest in Fundrise. I put $500 a month in it. And again, it grows my real estate. They do projects, and that's my other little pet project that I have. For those who don't want to come up with $300,000 down payment and a $1.2 million mortgage to buy a home in San Francisco or New York, you don't want to deal with tenants or remodeling, you just want to sit back and the investment being made, check out Fundrise. Fundrise is the one I use. It's free to sign up and explore, check it out. Mid-2017, this is Financial Samurai talking, I sold my San Francisco rental property for 30x annual gross rent and reinvested $500,000 of the proceeds in real estate crowdfunding to take advantage of lower valuations across the country, higher net rental yields. Talked about that earlier. Coastal city real estate become too expensive, and I expect people in capital to naturally flow towards lower costs of the country. The future of work is remote. Take advantage of a multi-decade demographic shift in the inland. Risk is 7, return is 8, feasibility 10, liquidity 7. You can sell whenever you need to. You may have to let them know. They take about a couple of months. Activities 10, pretty much chilling. Total score 42. Next, creating your own products, your own business. Finally, you're a creative person. You want to produce a product that's able to generate a steady flow of passive income for years to come. At the extreme, Michael Jackson makes more dead than alive due to royalties of his music. Since Michael's death, he's made $2.1 billion according to Forbes. It goes to his kids. Of course, it's unlikely any of us will replicate the genius of Michael Jackson, but you could produce your own ebook. You have an ebook, it's free. You can do an e-course like we do the options one. We get paid for that. Award-winning photos or a song, whatever. If you're a rapper or you want to make beats, hey, that's creating your own product, of course. Of course, it's unlikely any of us, 2012, he wrote a 180-page ebook about severance package negotiations that sells about 50 copies a month at $87 each without any maintenance. The book has been revised and updated for 2019 to teach people how to negotiate a severance package to give themselves financial runway for the next chapter in their life. He generated, Financial Samurai, $51,000 a year in passive income, as he does now. So he would need to invest $1.275 million in an asset that generates 4% yields to earn that much. To earn $10,000 a year in passive income, he would need $250,000 in capital, earning 4%. So not bad. He made an ebook, made $51,000 a year. That's passive, baby. Who would thought a book about engineering your own layoff could regularly generate so much revenue? We're so busy with our jobs that our childhood creativity sadly vanishes over time. So true. So create your own product. Maybe something that, find a need in the market. You never know. Maybe you have creativity that you didn't know you had. Leveraging the internet. Yes. Create, connect, and sell something is something every person should attempt to at least to do, given the startup cost is very low. It's really just up to you. Like this video is free. I just want to give it out free to you guys and help you guys. The only risk is lost time and a wounded ego. Big deal. And he has a step-by-step guide on Financial Samurai. Feel free to check that out. So here's a real income statement for a personal finance blogger who started his website on the side while he was working. So cost per click, 300,000 page views a month. I just did my own clicking here. You can see sponsored and everything. The guy makes about $12,600 in monthly revenue. See the breakdown. And he makes about $151,000 in passive. Income derived from having an online platform makes $186,000 a year. It makes 28 grand a month, $337,000 a year. How great is that? Risk is 10, which is great risk and return. Return is 9, feasibility is 7. Not everyone can do it. Liquidity is 8. You're not sure if you're gonna make money every month. And activity, you gotta do some activity, 9. So now he breaks down the passive income ranking. Based on his 5-factor model and ranking the best passive income investments, dividend investing, real estate crowdfunding, creating your products are the top 3. For those in the highest marginal income tax brackets, investing in municipal bonds is attractive because there's no federal or state tax to pay if you buy your state's muni bonds. So here are the rankings. Number 1 is creating your own products. That's the best. Number 2, real estate crowdsourcing, like Fundrise. Number 3, dividend investing. We talked about that. Fixed income and bonds, 40. That's 4th place. 5th place is CDs and money markets, P2P lending, real estate, and private equity. That's how it works. That's how the breakdown is. So here's Financial Samurai's earned income passive streams for 2021. Online savings, he makes $580 a month, about $7,000 a year, about 2.6% of his total. Stocks, mostly S&P, makes $2,200 a month, 26 grand a year. Bonds, mostly municipal bonds, $2,800 a month, $33,000 a year. Real estate, he has a condo, he rents it out, he makes about $3,000 every month, $36,000 a year. He has a rental house, partial, makes 12 grand a year. He has a Lake Tahoe vacation rental, makes about 10 grand a year on that. He made an ebook, he makes $4,000 a month on that, 50 grand a year. Venture debt fund, $19,000 a year. And real estate crowdfunding, he makes $69,600 a year on that. So his income, total passive income, is $265,000 that he doesn't have to lift a finger on. That's really the key to wealth, guys. Again, once you start making a lot of money, guys, the most important currency in your life will be time, because you want to enjoy your money. So this is the breakdown of passive income. Everyone talks about passive income. I just broke it down to you. This is the way to do it. There's different ones. They broke it down. Feel free to research a little more on this website, financialsamurai.com, ranking the best passive income investments. Like we said, you have your money right, you know debt, you have your savings, you did some investing, you have your 401k. Now it's time to build. Money brings money, guys, as always, and you'll get there. It won't happen overnight, but you'll get there. And you start building multiple flows of income. Before you know it, you'll be like a financial samurai. 1, 2, 3, 4, 5, 6, 7, 8, 9 different types of passive income, making $22,000 a month, $265,000 a year. Once you start making $22,000 a month like that, guys, it really is the world's at your feet. You could travel where you want, you could buy whatever you want, and you'll love it. You'll enjoy it. So hope this chapter helps about passive income. Make sure to do your own research, guys. Financial Samurai, I highly recommend them. They're great, and there's plenty of other resources out there and books. But again, don't be just caught into one box of just stock investing or real estate. There's other things out there. Take a look at them, do your research. And thank you so much for joining me for this chapter. We'll catch you for the next one.